Alright, I'm just going to review what happened. So in the morning, market rally, pull back, pull back, pull back, pull back. Here, it fooled a lot of folks when it went to spring this low. So I'm over here. You have market. You had the market rallying, very strong volume, very strong. All of that, right? It's going up, up. Here, the signal lack of demand is not really valid here because it looked into the prior session. So I'm still working on that, and I'll work on that later. But you have to compare the waves in the same session. You can't like compare yesterday's wave to today's open, stuff like that. It has to be in the same session. Anyway, over here, you have volume. When you have this, right? When you have a shortening of the thrust and all of that right here, usually this means that it's going to go lower and might spring this low. Very important. When the market goes up, down, doesn't really pull back that hard, and goes immediately takes out the high, it's a probe to go higher. That probe to go higher is not having follow through. So what happens, they have to find accumulation and they have to go down and spring this, take that, and then run it up. But whatever. Because they're unable to, over here there's no breakout buyers. They're not, piling on. So then they find pullback buyers and by taking out this low, accumulating the stops, and then bang it, going up. Anyway, so buying and then all of that. Here you had reasonable amount of volume, pull back, and then here. So this got really interesting because this gave the perception that the market was going to break down, right? This gave the perception that the market was going to break down because this is selling. This is selling, but that selling took out this low and dried up and then continued. However, if you are just looking at the market, because what happens is on trend days, what folks will do is they say, oh, look, this break and this rally, I'm going to take the short right under here, right? Right under there. So they're looking for what most folks are going to do. They see, oh, it took out one low, two low, three low. All right, and then it went up as weak, and then wait, bang! They're gonna take out the low. They're gonna short right here because it took out the prior low. So it's very important to understand this type of behavior and when it works and when it doesn't, because there's certain days where you will have a sell-off, and every time it breaks the low, it's going to continue. And other days where it's just a spring, and actually most of the time that's what it is. You could say that this was a minor spring. See all that volume coming in? There's a lot of, not volume, but activity coming in. It would have broken right through, but it sprung this high, went down, up thrusted that high, went down and did all that. So this is very important to know because on Wednesday, I don't know, last week, this type of move would have continued going down because we're in a downtrend and all of that. But today didn't even work because there's certain days where you just have so strong fundamental catalysts and all that, and it's just a sell-off day. So over here, what you had was try to go up, reversed on very heavy activity right there. What does that mean? The bulls defending the low. Why? It's the biggest in 31. So there's very heavy activity. Then it had a breakout. So if you're still wanting the short and the breakdown didn't work, then you're looking at this level up here for the retest. Goes up, tests. You're going to notice there's a breakout right there. That's a breakout. Rallies, what happens? Climax. There it is. That's the minor climax into resistance right there. And I want to talk about this, about climaxes and breakouts, and really how important, how they're used, And I don't know if folks cover this in traditional white glove literature. It's okay. Breakout is separate from a climax, right? That's what you've taught. That breakout is separate from a climax. Climax is on top of a trend, right? Breakout is above a range, two highs, and breaks out or breaks down, right? All right, forget that, because many times you have this situation where you have what's that, ABC correction, or a spring in a downtrend or uptrend. I'm sorry, spring and uptrend, or upthrust and a downtrend. So what's that? That's just ABC correction, right? ABC correction. Everybody knows this, right? So above this high, you have A. A. This is B. C. Right? You have that A, B, C bullshit. Now, here's what you need to know. The C leg is typically a breakout of the A leg, meaning the C is above A. It's typically a breakout right there because it takes out the high, little volume, activity, blah, 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 comes in here. Then it goes, it's either going to have inside wave or breakdown, right? So here, how did the turning point terminate? And if you examine this closely, you'll see it terminated on a breakout, on a minor breakout above the A leg. That's how the thing terminated and then reversed back down. The same thing can be said of climaxes. Minor climaxes and breakouts, they are a false breakout is also a climax. Many times a breakout is a climax. I know that's not traditional, but that is what happens. A good breakout with trend is usually a continuation signal, and a climax is an ending action, termination signal. But breakouts can be used as climaxes because when they break that level, volume comes in. When volume comes in, it has the same purpose, the purpose of distribution. And breakouts can be used for distribution, and then they go down. So right here, you can very easily have a breakout on that C leg, and then reversal back down. So that would be a false breakout. And you could also consider that a minor climax or whatever. So understand that typically what you're taught is you have a selling climax and a buying climax. So I understand that. I'm not saying anything about that. What I'm letting you know is that breakouts, false breakouts, have the same purpose as climaxes in that they're used for distribution and accumulation and ending the move and then reversing it back. All right, so it happens all the time. I probably find it here. There you go, right there. If you see this, if I draw the line here, that bar right there has high volume and high activity right there. It breaks 1, 2, 3 lows. It breaks 1 low, 2 low, 3 low. It is a breakdown. That bar is a breakdown. Its volume is high, its activity is high, it breaks the low, it increases in thrust and range and whatever you want to call it. All of that. And what happens? The market goes totally the other way. Look at that. So what is this? It is, if we put behavior to the side, this right here is a means of causing selling and the other side buying. Again, it is a means of causing selling to create selling and to buy. The other side will buy. A lot of folks are selling, other smart money is buying. This breakdown takes out these lows, incites selling, and the other side is buying. So we know that you can call this a false breakdown. You can also call this a spring, but in my book, like, this can also serve as the same thing as climactic action, in that the purpose is the same, to cause some, I don't want to say panic selling, but I mean just selling, or to draw in the sellers, the shorts, in order to then reverse it and take it higher. So breakouts can be climaxes, they can be ending action. You see this at the end of the pullback, the 1, 2, 3, 4 leg pullback. This is the end, and then it reverses and goes up. So breakouts can represent ending action. This is what I'm trying to get across. Breakouts can be ending action, and therefore they can be climaxes because they represent ending action. They can bring in the other side to, sell to or accumulate from. And that's exactly what happened here, right here, folks. So this is very important to understand this, because on trend days, this right here would have fall through and go straight down, because you're in trend day, markdown day, or whatever, strong catalyst, etc., etc. But on other days, they don't work. They have a high probability of not working, and you must have follow through and test. For example, here you have a breakout. This right here is a breakout. What distinguishes this from that? What distinguishes this is all of this follow through. That follow through is helping to validate the breakout. That takes out 1, 2 highs on very heavy activity, has follow through, continues to a high wave. Then the pullback here is a good opportunity. Okay, so you could consider this break of these 2 highs a breakout with follow through, and this one a breakdown with no follow through, representing ending action and also being climactic. And from a bar perspective, it is climactic. There's a lot of volume and pressure and activity, all that. So I want to make that clear, because breakout trading, those guys are getting annihilated right now. They're not on, they're just going to get annihilated if they're not in momentum type follow through and markup or markdown. It's not going to work. You see? So remember, all right. So the other thing to note was this trap right here. You see this? Before this was a green candle, it was a red candle taking out these lows. What happened? Reversed, and look at the move. So this breakdown became a green candle, tested, and rallied. So what did this do? This breakdown again was ending action and reversed higher to test. This breakdown, ending action, reversed higher. So what does that mean? It means breakdowns have a similar, breakouts and breakdowns can be the same as climaxes in their purpose. All right, now that's from a behavior and all that. So, and go ahead and check your charts. You'll see. And on the daily, especially, a lot of markets they have this. All right, so a couple of things I wanted to share with you all. All right, so the market is going up, right? Is there any indication, and this is going to be more of a teaching lesson? All right, anyway, so you have this uptrend 144, 62, 115, right? Is there any indication that the market is going to fall? Is there any indication? To me, no, there's nothing. There's nothing. There's no indication here that the market's gonna reverse. Zilch. All right. So from this uptrend, they're making higher highs and all that. There's no indication that it's going to reverse. It just does. And what it does is it pulls back to a support level where it springs. So now let's analyze this piece. When we're analyzing this piece, we see this heavy selling. And this is where you can get a lot of trouble, folks. You see this heavy selling. Up, down, up, 49, 17, 11. The market looks very weak right here. It looks very weak right there. Why 79 to 11? 79, 49, 17, 11. In a downtrend, this shit would just go straight down. Straight down. I don't know what's holding it. It could be because of this support. And springing, testing. Right? So I don't know. It could have, if there was more momentum, it would just break down. And also, ES has likes to up thrust and all that stuff. So what it did was it just went right back all the way up here to test and then pulled back some. So this is typical ES behavior. When you have this, instead of breaking down, it's going to go in reverse and test the high and then go down. Right? And it does. It does. So right here, you don't really see anything. You don't see anything except one. This right here. That key behavior, 96 volume, is greater than 79 volume. This is buying, folks. Meaning the attempt to go down here is met with buying pressure. And it's the biggest wave in, 5 or 6 wave, whatever that means. Now, you're going down here. What tells you here that you have a possibility of reversal? What tells you? So you're going down on 50, then 36, then 60, then 10. There's some very, very key things. I'm going to explain what they are. First thing is, that's the biggest volume in 6 waves. What's the difference between this and that? The difference is, and this is why you can't do everything mechanically, you have to apply judgment. But the difference is, take a look at the low-to-low thrust. The prior move had 36, 100,000, I don't know, what do they have there? I don't know, 36, I just supposed to say 36. It's a lot. It's much more than 36, but I forget how many zeros and all that. Anyway, so it goes down on 36, you have this much movement. The second one, look at this. Look at this. Is that not effort right there? Obviously, it's effort. It's effort, right? Because from low to low, what happened? You had almost double the volume, but where's your reward? It's not there. So does that mean you go long? No. What that means is you wait for the reversal trend change. If you get it, you get it after one more tap right here. Here, yeah, it's very clear. This is your lack of supply. And remember, effort and lack of supply, they like to hang out together. It always happens. They love to hang out together. It always happens. So this right here is your effort. How do you know? Look at the distance from low to low. It's garbage, right? So what does that mean? It means it's hard to go down, right? Then it goes up, and then lack of supply. Now it reverses. So this is telling you that two things. Market is not going down. Bulls know it's not going down, and that's why they're stepping in. Bulls know it. They know it's not going down, they're stepping in. This is confirming this action. After you have effort, after you have lack of supply, you must have strength. Okay, and this is the most amount of strength in the prior 3 down waves and takes out that high, so that's your strength. And then it pulls back and goes. Alright, so this is turning point trading. You could do breakout and all of that stuff, but I think just know that breakouts and breakdowns, they're used for both continuation and termination signals, as I've indicated, giving you clear examples right there. Give you a clear example of that breakdown. And over here, before this was a green candle, it was a red candle and then reversed. And look at the move. It just reversed and took out the high. Took out these highs, made a breakout, blah, blah, blah. So anyway, so if you want to understand what's going on here, it's basically a rally and all this shit in here. And then finally you have effort, lack of supply, and ready to reverse. This is tapering with waves. Alright? And but one important thing is that you don't want to ever do is just use mechanical signals, because there are too many situations, and you have to apply judgment. Even if the mechanical signal can just tell you, hey, take a look, but you need to take a look at the background and figure it out. And that's why signals with Wyckoff or any methodology will not work. I've seen dudes try to do upthrust and spring signals on waves. Don't do that. It's not going to work, because you don't know if it's an upthrust or a probe to go higher. You don't know if it's a spring or a probe to go lower. So no matter what you do, it mechanically will not work. You must apply judgment. I knew this here. I knew this not because of just the wave, but because of this. The rally in the background and the failure. The failure to go down, then the rally in the background, then this weak wave, right? And you know what was also a tip-off? The other tip-off is typically in consolidations, you're going to get a clue before the market continues trend, right? Before it continues trend, you're going to get a very interesting clue. Remember that trend has a characteristic where if it's an uptrend, the up waves have more volume than the down waves. If it's a downtrend, the down waves have more volume than the up waves. This sometimes you find during the consolidation, and I will tip you off. What do you notice? If you're looking for uptrend continuation, the up waves have to have more volume than the down waves, right? So now let's watch this. Right now, 50 and 27. Where's the more volume? Down wave. 36 and 27. Where's more volume? Down wave. So it's continuing trend. Over here, 60 and 37. Where's the more volume? Down wave. Over here, oh shit. The relationship changes when you compare 37 to 10, and further 47 to 35. Now, where's more volume? The up waves. 37 is greater than 10 and 47 is greater than 35. During the consolidation, this is your clue that the market will go higher, because in an uptrend, up waves have more volume than down waves. So that characteristic of up waves having more volume than down waves, many times it reveals itself during a consolidation and will tip you off that demand has just taken control. And here you have like twice it happens, telling you it's going to go higher. Right here, 37.10, 47.35. So you know it's going to go higher. There's one other clue for folks who know Wyckoff. This 10, you always want to understand what this 10 right here. This is the lowest volume on the chart. So it's the lowest volume on the chart except for here where it matches it with another 10, right? Out of all the down waves, 50, 44, 75, 28, 50, right there. You know this is very, very bad for supplies, especially when it reverses up. It's like the lowest volume of the day. So there's no supply, and it will reverse. It will reverse, and that's what it did. So all of these clues are available for for this style of reading wave volume. I'm not saying that's the only method. I mean, many folks will what they'll do is say, oh, you know what? Where's resistance? Where's support? Let me draw a line. Okay, what's the behavior there? All right, what happened here? Breakout. Okay, follow through. All right, what are we going to do next? We're going to draw a line. What happens? Test the breakout. What happens? Reverses. Okay, buy the pullback, go up. That's it. Right? But you have to be ready. You have to be ready, and you have to know that here, right up here, you also had a breakdown. You had a test, and it went down. Here, you have a breakout, you have a test, and it goes up. So those two perspectives of breakdown and breakout are also in your mind. So maybe that works. All right, I'm done. Take care.